What's going on, everyone? It's Steven. I want to talk to you guys today about something that is really cool that I've been doing for about a decade or so, and it's really been helpful for me in looking at the overall stock market. So obviously today is December 3rd, and we're getting really close to the end of the year. 2018 is on the horizon, right? But not many people know exactly how high or low the market might go in 2018. Don't you think that would be helpful for you to know? I think that would be very helpful for you to know. It's been very helpful for me and a lot of my students in the past. We know, and I know exactly how high or low the market can go in the next year with a really high accuracy. Isn't that cool? Wouldn't you guys like to learn? So super happy having you on this video right now. I'm going to get into my keyboard right here. I'll see you guys on the other side.
All right, everyone. So now we are inside the computer. We're inside the computer. And we want to talk about how high or low will the market finish in 2018. So this is something, obviously, today is December 3rd, 2017, and we're looking out for 2018. We've made a lot of money in 2017. We've done really well, but we don't want to stop there. We don't want to coast. We want to get ready to make even more money in 2018. That's what we want, right? And I love this picture of me on the right. I love it. It's kind of funny. But the truth is, you know, like anything in investing, how are you really going to be able to grow your account without having some sort of a game plan? And what's really cool, and my goal here for this video, and again, guys, this is my first YouTube video, so if you have any feedback, comments, anything else you want to learn, just add them to the comments below, and I'll give you guys exactly what you want. I'm hoping with this channel I could really teach a lot of people to really make a lot of money in the stock market. And the first way I want to do it here is give you a 2018 game plan, right? Because again, how are you really going to grow your account? How are you really going to crush it? How are you really going to be able to put that extra $100 or $1,000 in your bank account every single month with your investments unless you really have a game plan? So let's start off with a very high level 2018 game plan, right? With figuring out how high or low the market will close in 2018. And the cool thing is, finding this out, it's something that's actually been right under your nose all along. But think about this for a second. How helpful will it be to know exactly how high or low the market will finish in 2018? Right now, you probably think it's just, oh my God, like there's no way to actually know. Actually, there's a way that gives you a really good chance of finding out. It isn't 100% exact, but it's really close. So you guys want to know exactly how? Let's dig right in. So this is probably how you'd find out now, right? This is probably how you would do it now, right? You would go over to Google, right? You would type in the phrase, how high will the market close in 2018? Because if you've been in the market for the last decade, you never even considered the fact that there is a downside to the market, since we've been in a bull market for the last 10 years in a row. In fact, I guess this week we hit a new all-time high in the market, so no one ever considers the downside. What you'll do is you'll click on the top 3 search results and read what the likes of Jim Cramer think, what Goldman Sachs think, and maybe even what the Motley Fool think, right? So you see what one of the top investment people think, one of the top investment banks think, and one of the top investment, research newsletter websites think. You would like to go see what they think. And ultimately, you'll take what they think, and you'll come up with a number that's somewhere in the middle, or that pretty much just has to do with the way you think the market is going to go next year, which undoubtedly is higher. So again, people kind of get a little messed up at this point. The market can go down, although it's less frequent than it used to be. And again, over the last 10 years or the last decade, it's gone straight up. It can go down too. So people think one way, and then they just say, okay, these authority figures, I'm going to take what these authority figures have come up with because they know more than me, and I'm just going to go ahead and pretty much come up with what they think. But how did they come up with those numbers? Do you know how Jim Cramer, how Goldman Sachs, how the Motley Fool actually come up with those numbers? I don't really think that you guys know that. So let me tell you what happens. So they have these big teams. They have these huge teams, right? And they have these teams of people read all the balance sheets for all 500 stocks on the S&P 500. So I'll stop right there because I think I went a little bit ahead of myself. When we say the market in 2018, we're not talking about the Dow, we're not talking about the NASDAQ, we're not talking about the Russell, we're talking about the S&P 500. And the reason we talk about the S&P 500 is because that is the index that all professional investors look at every single day and is the largest index that gives us an overall understanding of what's going on in the stock market in a given day. So the S&P 500 is a basket of 500 stocks from all different sectors and walks of life. So there are industrials in there, there's technology, there's commodity, right? There's consumer staple, there's healthcare, there's all different types of stocks. So it gives you a good understanding of not what one sector does on an individual day, like the NASDAQ would in technology, but what the overall stock market is doing on a given day. So again, they read all of the balance sheets for all the 500 stocks in the S&P 500. That would obviously take a very, 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 very long time. Balance sheets are hundreds of pages long. On top of that, they talk to as many research firms as they can. So there are research firms out there, Moody's, Standard & Poor's, that do research for you. So you can go there and you can go say, hey, I only want to read 400 of these balance sheets. Give me the cliff notes on the 100 other balance sheets. And again, this is what they do. Then they send their teams all over the world because just reading balance sheets is good enough, right? They send their teams all over the world looking at manufacturing plants, speaking to board members, executives, talking to locals, seeing how much foot traffic is going on in any of these retail outlets, right? They go above, and they do even more. Then they look at all the different exchange rates for all the U.S. companies that do business in other companies. So if we look at a stock like Apple, or a company like Apple, Apple does business in 22 different countries, right? So you have to predict what the exchange rate is going to be based off of those other countries that Apple makes money in. So you have to say, how much do I think Apple's going to make in those 22 different countries, and then do an exchange rate in 22 of those different countries and figure out what currency is going to be going on, what currency is going to be up, what governments are going to be strong so their currencies are going higher, et cetera, et cetera. You got to figure out all of that. And then on top of that, you have to predict, because you don't know, you have to predict earnings growth for the next year for those companies based off of all these different factors, right? And then you take that prediction and then you kind of do a market cap weight and come up with the blended average, which is the target of the S&P 500. Does that not sound nauseating or what? I mean, does that not sound just completely nauseating, completely ass backwards? I mean, how can we have something as simple as giving us a number that takes months, costs us millions of dollars, and come up with, and that doesn't really even make that much sense at the end of the day, right? But let me ask you a question. How do you know that the numbers are accurate and impartial? The reason I ask you impartial is because investment banks who come up with higher price predictions for the S&P 500 typically are the ones that get the most investment from institution and clients. And when they get the most investment from institution and clients, they make the most money because they get the highest commissions, right? So do you really have a very strong confidence that the numbers are impartial? Well, I don't really, right? Do you know which economic factors, geopolitical risks can change the analyst's expectations and to what extent? Right? Do you actually know that? No, you don't. And at the same time, and most importantly, how do you take those expectations and actually make money from them? Because that's the most important thing. And again, they don't. They just give you a number and say, okay, here's the number that we think the S&P is going to finish at the next year. But there's so much in there that is so unknown. Guys, look. What if I told you there was a better way? What if I told you there was a simpler way? What if I told you there was a way to figure out how high or low the S&P can go in the next year? And what if I told you it will take you less than 30 seconds to figure out? And even better yet, what if I told you that there were tens of trillions of dollars bet on this number. So forget the fact that some nice, fancy, wealthy investment bank is going to get 30 of their analysts to fly all over the world to meet with all these different companies, look at all these balance sheets, right? Come up with a number that may or may not be accurate, may or may not be impartial. Wait, what if I told you I had a better way than that? That tens of trillions of dollars every single day is agreeing on this number, which again is the price, which is a price prediction for the S&P 500. What if I told you there was a way to find out that information in less than 30 seconds time? Would you be interested in something like that? Well, you're pretty dang close. So what's the VIX? Now, guys, I know this is probably something that you don't think is correlated at all, but I guarantee you in less than a minute, you're going to find out exactly why. So what is the VIX? Well, according to most people, right, the VIX is the fear index, which is a numerical representation of the amount of fear or risk at a given time, which is shown by the buying and selling of options on the S&P 500. Get rid of that, because that's a load of crap. The VIX is nothing more than the 1 year expected move in the S&P 500. So when the VIX is lower, it has nothing to do with the amount of fear out there. It has everything to do with being the expected move in the S&P 500 for the next year is just a little bit smaller. And when the VIX is higher, it really doesn't have much to do with fear being out there. Ooh, fear being out there. It has everything to do with the expected move in the S&P 500 over the next year is just a little bit larger. So let's actually break that down. Again, if the S&P 500 is at 2,500 and the VIX is at 10, that means the expected move for the next year in the S&P 500 will be up or down $250, right? That's 10% of the price. That's what the VIX is, guys. The VIX is the 1 year expected move in the S&P 500. It has nothing to do with the fear index, risk on, risk off, none of that stuff. And again, trillions of dollars every single day are bet on this being dead true. Isn't that pretty cool, guys? Isn't that pretty cool? You walked into here in this video and you thought all along that the VIX was all about all the fear going on, when really it's just the expected move over the course of 1 year in the S&P 500. So when we have a price of 2,800 and a VIX of 15, right? 15% of 2,800 is $420. So we can see a high end of the range of 32.20 and a low end of the range of 23.80. That is based off of trillions and trillions of dollars being bet on that every single day. When we have a 2,200 S&P price and a VIX of 20, that means a 20% expected move in the S&P 500 over the course of the next year, or $440, right? When we have a 3,000 VIX, a 3,000 S&P price and a 25 VIX, that says the S&P 500 over the course of the next year has a 25% expected move up or down, which at a 3,000 price is $750. And the last little area here, which is the highlighted here in yellow, is where we stand today. So today, the S&P 500, being December 3rd, right, it's a Sunday, so the closing price of the S&P 500 is $2,642.22. The VIX, as everything stands right here, right now, is 1143. So that says the expected move in the S&P 500 over the next calendar year is 11.43%, or up or down $302. So the high end of the expected move for the next year in the S&P 500, based on the VIX price and what trillions of dollars are betting on, is about 2,944. And the low end of the range, again, based off what the market is betting on, and they're betting trillions and trillions of dollars on it. The low end of the range is about 2,340, right? So that's what it is. So you guys are probably saying, oh, wow, that's amazing. But, ultimately, I just want to make money from it. Great. Let's start getting you there. So we did a study for this. We went back to 1980 to present. So this is 37 years of data. To me, that's a pretty big sample size. So we're going to move forward. What we did was we went back to January 1st of every single year. And what we did was we calculated the 1 year expected move of the S&P 500 based on the current VIX price. So imagine we went back to 1 year and the price of the S&P 500 was 2,500 and the VIX was 10, right? So that's what we calculated. So we calculated the expected move based off that, which would have been up or down $250. So the first thing we did was we checked to see if the S&P 500 closed within its 1 year expected move, right? So the example is if it closed between 2750 or 2250, we made note of that. The second thing we did was we made a note if the price of the S&P 500 went outside of the expected move at all to the upside or downside. So again, in our example that we're looking at here, the first thing we did was we said, okay, on January 1st, here's the price of the S&P 500, and here is the VIX. This gives us a $250 expected move. So the high end of the range is 2750, and the low end of the range is 2250. Now again, guys, we're not making up any of these numbers. These are all based off what the market thinks, right? The market agrees on the VIX price, which again, trillions of dollars are betting on every single day. So this is very, very accurate to what the market believes. Not some suit at Goldman Sachs, not some fancy research firm that flies their private jet all around the world to figure out their own number, which again is not very biased, if you will, and who knows the accuracy. But this is what the market is saying. So again, the first thing we did, 2,500, 10 VIX. That means it's a 10% expected move over the course of the next year. That's up or down 250 points. High end, 2,750. Low end, 2,250. That's the first thing we did. And the second thing we did, the first thing we did was we checked to see if the S&P 500 closed within its 1 year expected move. So what we would do is we would go to December 31st and see the closing price of the S&P 500. So in this year, if the S&P 500 closed between 2750 and 2250, we would make note of that. And the last thing we did was we would make note if the price of the S&P 500 went outside of the expected move at all during that year. So if at any point the S&P 500 was above 2750 or below 2250, we made note of that. Right? And again, we did this over 37 years, so the sample size is pretty big. Now, the goal of what we're trying to do here is we're trying to see how accurate this representation of expected move is, or the 1 year expected move, just based off of the price of the VIX. Right? Remember, we're not jet setting to figure this out. We're not going to research firms or doing our research online to figure this out. All we're literally doing is getting the price of the S&P 500, which you can get from Google or Yahoo in about 2 seconds, and the price of the VIX, which again, you can get from Google or Yahoo or any trading platform in literally 2 seconds. That's all you need to figure out what the market is betting on for the next year, right? So we're looking to see how accurate that is. So let us look. So over the 37 years, you'll see that the S&P 500 closed within its 1 year expected move. And again, that's based off of the VIX. 32 times, or about 86.49% of the time. So better than 8 out of 10 times, this equation is accurate. I would say that's really, 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 really powerful, especially because it doesn't take us more than 30 seconds to figure this out. about half of the time, 18 out of the 37 years, about half of the time, the S&P 500 went higher at some point. At some point was higher than its high end of the range of the expected move, right? So that's about 50% of the time. And about 25% of the time, it went lower than its expected move. So what we're saying is about half of the time it goes above its high end of the range, and about 20% of the time it goes below its low end of the range. But now is where it gets really, really interesting, guys. It went higher than the expected move, but then came back, went lower, and closed within 83% of the time. And yet, it went lower than its expected move, but then went higher to close within its expected move 77% of the time. So now it gets really, really interesting. While I agree it's fantastic to have an easy way in less than 30 seconds to see what the market is predicting the S&P 500 will do for the next year, and again, that being accurate over the last 37 years about 86.49% of the time. So 85 or 86 times out of 100, excuse me. While that is great to know, right? This is where we really start to be able to make some money from it. This is where we really start to be able to make some money from it. Because what we can see here, as plain as day, is that 83% of the time, when the S&P 500 at some point during the year gets above its expected move to the high end of the range, it comes back and by the end of the year finishes within its 1 year expected move. And at the same time, about 77% of the time, if at any point during the year the S&P 500 is lower than its expected move to the low end of the range, it goes higher and by the end of the year finishes within its 1 year expected move. This is some really, really, really powerful stuff, and let's see exactly what it takes and what we could do to make money from this, right? That's ultimately why you're here, right? So on January 1st, 2018, calculate the 1 year expected move in the S&P 500 using the VIX. Remember, the VIX is just a representation of the 1 year expected move in the S&P 500. So on January 1st, 2018, if the VIX is at 10, that is a 10% expected move in the S&P 500 for the next day. So let's say the S&P 500 is at 3,000 on January 1st. That is a $300 expected move up or down. So all the way up to 3,300, that's the high end of its range on the expected move of the S&P 500 for the next year. And 2,700, that's the low end of its range, right? So what we want to do is we want to calculate it. And we want to write that down on a sticky note. And we want to put in that high end of the range and the low end of the range. And what we want to do is stick it on whatever we look at when we make our trades or investments every single day. And now we want to get to the really, really good stuff. If the S&P 500 breaks above the 1 year expectation at any point in 2018, there's an 83.33% chance that it will still finish within its range. Maybe that is a good opportunity to take some profits. Again, the reason it might be a good opportunity to take some profits is because 83.33% of the time, it will finish within its expected move, which will mean prices will have to come down. That's right, 83.33% of the time. And then the other side of the coin, if the S&P 500 breaks below the 1 year expectation, 77% of the time, it will again go back higher and finish within its 1 year expected move. Maybe that is a good opportunity to buy more stocks. And the reason that it might be a good opportunity is because, again, 77% of the time, it will go higher by the end of the year and finish within its 1 year expected move. So again, guys, this is my first video on YouTube. I hope it was helpful. To me, this is something that I've been doing for the last decade, and again, it works. Based on the VIX and the starting prices over the last 37 years, guys, over the last 37 years, the 1 year expected move, that's based off the price of the VIX, the prices have closed within that expectation 86% of the time. And the cool thing is, when prices go outside of that expectation, there is a high likelihood that they revert to the mean and close within that 1 year expected move. And we can profit from that by maybe taking our foot off of the gas when prices go above their expected move, and maybe putting the gas on a little bit more when they finish below. So if you want to make money based off of this, number one, the VIX is not the fear index. The VIX is the 1 year expected move in the S&P 500. And again, trillions and trillions of dollars are being bet on that all the time. Knowing that, at the same time, 86% of the time, that is an accurate estimation of where prices will fall in the next year. So knowing that is a very good number to look at and a very solid number to look at statistically. If prices go above that expectation, maybe it's a good time to take some profits, because 83% of the time, prices will revert to the mean. They will come down and finish within that 1 year expected move, 83% of the time. And if it breaks below that 1 year expectation, maybe it's a good time to buy a little bit more, because 77% of the time, that's right, 77% of the time, stocks will rise and rise to a point where by the end of the year, they will finish within their 1 year expected move. So guys, hope this was helpful. Again, this is my first video. Hope it's helpful. If you guys need more information about this, you want me to talk about other stuff, just comment, and hopefully this could be a great place for you guys to come and eventually make some money. On this one, guys, this is a pretty simple one, right? This is a pretty simple one. I hope you guys use it. I've been using it. Some of my market heroes have been using it. Guys, it's some awesome, awesome stuff. You know, don't think, take action here, guys. Again, this is a super, super, super high probabilistic outcome here, guys. So, again, this is based off the numbers. This is based off the VIX. Trillions and trillions and trillions of dollars are betting on this at any given time. So it's super, super accurate, guys. Again, no emotion here. No jet setting in one of our Gulf streams to go all over the world to figure this stuff out. We figured this out in about 5 seconds looking at the S&P 500 price and the price of the VIX. And here we have the numbers, guys. These numbers don't lie. 86% of the time, the S&P 500 finishes within its 1 year expected move when we have the VIX as the 1 year expected move, right? And 83% of the time, when it's above its 1 year expected move, it still closes within. It's 77% of the time when the expected move gets breached to the low side, to the downside, prices come up and finish within their 1 year expected move. And that is an excellent opportunity for us, an opportunity that I always take advantage of, and I hope you will too. I'll see you guys in the next video.